The Fed kicks off its two-day meeting and the earnings season kicks into high gear. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. U.S. stocks taking a bit of a breather from making new highs, although look at that, the S&P 500 just crossed into the green, up marginally by just over 1 point. Treasuries falling on the short end, so you have the 2-year yield, or I should say the 10-year yield, moving down to 4.05%. At one point, the 2-year yield did rise as much as 7 basis points. We are, of course, embarking upon the Super Bowl of tech earnings this week, and Microsoft and Alphabet will be reporting after the close. The two are down right now. Do the two biggest players in AI software deliver, Romaine?
Yeah, that's going to be a big question. Of course, full coverage after the bell on that as we keep an eye here on the stock market rally that, well, quite frankly, is on pause for a second day here. Bond yields constrained and the dollar flat as well. This is ahead of Wednesday's twin event of Treasury refunding details and the Fed's first meeting of the year. That meeting underway now in Washington, where the combo will be about how to tweak that policy statement in a way that hints at how close or maybe how far the committee is from cutting rates at future meetings. Treasury traders, though, already moving to cover short positions with the largest drop in open interest futures right now occurring on that 2-year note. Keep an eye on that because that's where the volatility could be tomorrow. But as investors brace for any shifts in the macro story, earnings season is in full force. And it's a bit of a mixed bag. Fourth quarter EPS on track right now to exceed preseason forecasts with growth of about 2.3%. Financials, consumer staples, and industrials rebounding, while energy and healthcare on track for double-digit percentage declines. But let's not kid ourselves. Tech stocks, that's all we really care about here, and that's still where the earnings growth is right now. Without the top 7 stocks in the S&P, it's still contending with a profit recession with a projected EPS decline of 6% for the fourth quarter. That's if you back out the Magnificent Seven. And maybe that explains why the latest bout of market strength was narrower than the last. The quant strategists over at JP Morgan say the share of the top 10 stocks in the MSCI USA index, that includes all the Mag 7, rose to 29.3% by the end of December, and only 4 sectors, Scarlett, are represented in the top 10. That compares to a historical median of 6.
Yeah, I can imagine which ones were not included, and they probably begin with financials. All right, for U.S. equities, market concentration, as Romaine was mentioning, was the theme in 2023, and it's the theme so far in 2024. The white line is the Magnificent Seven. The group has driven a huge portion of the broader market gains, as you can see. The blue line is the S&P 500, excluding the Magnificent Seven. Both have obviously seen increases in market cap since the start of 2023, although it's been kind of rocky for the 493 other stocks. But clearly, the 493 have quite a ground to make up. We're going to see whether this week's earnings reinforces this narrative. But let's not forget the macro setup either. We got a hotter than expected read on job openings today, and that, coupled with the absence of Fed speak right now, has traders feeling slightly less dovish. Fed funds futures right now are pricing in just over 5 rate cuts this year, from a big shift from where we were in mid-January, which was 6 to 7 cuts back then. Romaine?
All right, let's kick things off here with Ed Yardeni, president over at Yardeni Research. A conversation here, Ed, as we start here with the earnings season. There's a lot of talk right now about some of those valuations, and particularly the idea that some of that broadening of the rally that we seem to talk about the last few months might have been a little bit of a head fake, because if you look at some of the latest fund manager surveys coming from various corners of Wall Street here, people are crowding back into big tech once again.
Yeah, I think that's absolutely right. We had a broadening out, as you said, of the market since the probably late October of last year. I think that's approximately when the market started to conclude that the Fed definitely was done raising interest rates, and we all started to debate about how many rate cuts would occur in 2024. And the small cap, mid cap stocks started to do really, really well. And then it all kind of petered out over the past couple of weeks. And I think that's because there's still concerns out there about when the Fed's going to lower interest rates. The Middle East crisis obviously is a concern, as and other geopolitical hotspots.
And this gets us to this idea. We were talking about that report that came out by that quant team over at JP Morgan, using the word bubble, basically saying that when you look at some of the concentration in the markets here, it presents risk, not quite on par, but certainly getting there, at least in their view, as to what we saw back in the dot-com bubble.
Well, I think there are similarities, but one of the big differences is the Magnificent Seven certainly have lots of earnings and lots of earnings growth. So I'm not sure that we can, at this point, characterize it as a bubble. But I am concerned that if, in fact, the Fed comes out too dovish, that these stocks will continue to run, and then there'll be a lot of similarities with the late 1990s. But look, Jay Powell must know that the economy is doing awfully well. He's going to acknowledge that. He's going to acknowledge that inflation has come down quite a bit. He's also going to say that financial conditions have already eased pretty dramatically, implying that maybe the Fed doesn't have to be in any particular rush to lower the Fed funds rate, especially given how strong the labor market still is.
Dr. Ed, does he acknowledge the market's pricing in 5 rate cuts this year? Is he comfortable with market positioning on that?
I'm not. I did not really believe 6 to 7 a few weeks ago. I don't believe 5. I think maybe 2 or 3 at most, because look, the economy doesn't really need it. The Fed definitely has tightened, obviously, over the past few years, but it's also normalized. Interest rates are back to normal. They're back to where they were before the great financial crisis, and the new abnormal back then was 0 interest rates and quantitative easing. We're back to normal now. We're finding that the economy can actually live with normal interest rates, and that's good for investors who don't want to take a lot of risk, and it's good for allocating capital more rationally.
You had mentioned geopolitical risks, so I want to bring back the idea of what's going on in the Middle East and how oil prices have slowly moved up. Brent crude, obviously, people are looking at some big round numbers there. Right. How are you thinking about how to protect against those big moves in crude oil?
Well, I am thinking that this is unfortunately somewhat reminiscent of the 1970s, where we had 2 geopolitical crises, 2 energy crises, oil shocks. And we had one this time around not too long ago in early 2022 when Russia invaded Ukraine. And now there's a potential for another one, given how crazy things are in the Middle East. I think you've got to own some energy in this kind of environment. I think it's a hedge against things getting more out of control in that part of the world. I think the technology names may be benefiting from all the commotion because they are able to kind of grow through thick and thin. And maybe there's just a lot of nervousness that if things really start to blow up in the Middle East, then we could get a recession out of it after all.
I am curious, just real quickly here, Ed, how the Fed and really any central bank would even respond to that situation. There's been a lot of discussion about that.
Yeah.
And one of my colleagues actually went through a lot of the transcripts, Fed transcripts from past crises over the year, geopolitical crises. And it was interesting to see the debate that went on behind closed doors and kind of the resignation that there was not a whole lot that they can do.
Well, there isn't much they can do, but they have to consider whether they really want to lower interest rates right now, given that the economy doesn't seem to be calling for it. And if they lower interest rates now and then suddenly we get a spike in oil prices and inflation makes a comeback, then do they want to reverse course and suddenly be raising interest rates? So right now, I think they would be well advised to just leave things alone, given the political uncertainties, the geopolitical uncertainties.
All right, Ed, going to have to leave it there. We'll talk again soon. Ed Yardeni there,
Absolutely.
President of Yardeni Research, helping us kick off to the close here on this Tuesday afternoon as we focus ahead, 2 weeks ahead to the Super Bowl. The Kansas City Chiefs facing off once again against the San Francisco 49ers as they prepare for that rematch. We're going to talk to the president of the 49ers, Al Guido.
And you're going to be at that game, right?
I will. I'm actually going to be left center there.
All right. Plus, JP Morgan releasing its commodities outlook for the year ahead. We're going to talk with Natasha Kaneva. She's head of global commodities at JP Morgan.
And UPS revenue down 9% last year. Union labor costs up 12%. And the company today cutting management level jobs by 14%. A deeper dive into what's ailing Brown. All that and more coming up next. This is The Close on Bloomberg.
We've seen the Houthi attacks, but the impact has been much more on rerouting of ships rather than lost supplies. And I think what the market's looking for is, it's ratcheting higher, but there's not supply losses. But you can't also say that the risk of escalation is zero.
They're assessing what's required and also what's required from the medium and long term. I don't see any change from a long-term perspective, and I think they will go forward with the capacity increases that they've said.
We have to ask the question over what timeline. In the short term, we don't need 30 million barrels per day. There's ample spare capacity because OPEC Plus have cut production. Saudi Arabia, even producing 12 million barrels per day, could bring back 3 million barrels per day.
But to reassess timing and look at the situation is clearly understandable. And as I get more information, we'll work with them and understand what it means. And as you look at international markets, we continue to see international markets be positive for 2024.
Those are highlights from our own Alex Steele and her interviews out at the Baker Hughes annual meeting in Florence, Italy. Now, JP Morgan is out with its own commodities outlook. The firm sees Brent crude trading in a wide range, $70 to $90 a barrel, gold ending the year at $2,300 an ounce, and a year-end target for U.S. nat gas of $4. Joining us now is Natasha Kaneva. She is head of global commodities strategy over at JP Morgan. Great to see you again.
Thank you for having me.
And last time you were on, you recommended the sell-off in crude as a buying opportunity with a price target of the high 80s by May. And we have seen crude oil move up quite a bit. Brent oil now at 82.79. What I'm curious about is, given all the geopolitical tensions that have been rising of late, why isn't that having more of an impact on crude oil?
Well, first of all, thank you for having me. So you're absolutely correct. The price is up almost 14%. It's $10. So we estimate that $5 out of that is actually just pure fundamentals. Fundamentals have been improving. Demand so far has been actually very good and above what the historical seasonality would suggest. But $5 is the geopolitical premium. And of course, what is happening in the Middle East, this is a very visible and clearly growing threat to the global energy markets. But as absolutely correctly was pointed out, actually, we do believe that the risk of escalation is actually limited, just because the main parties in the region actually have very strong incentive to avoid a larger confrontation in the region. And the argument we're making actually is that so far they have acted accordingly. The second point to make is that, of course, all those issues in the Red Sea that we have been witnessing, that all of that could be handled by just a bigger reliance by the Gulf state producers for pipelines, but also rerouting around the coast of South Africa.
I do want to talk about the Gulf state producers, because Saudi Aramco surprised the oil industry by announcing that it will not proceed with plans to boost production capacity by about 8%. It didn't actually give any explanation. Why do you think that is?
Well, we cannot comment on individual names,
Sure.
but again, our outlook and our view since November 2022 actually has been that demand will be great, but non-OPEC supply will be even greater. And if you look at our balances in our price forecast, actually the balances for 2025 and for 2026 as well have been we're witnessing an oversupplied market. So the argument is we don't need additional capacity as of now.
Is there enough discipline there that you think that we will actually see that supply capacity come down? Enough discipline among the OPEC plus
among
members.
the OPEC. So far, we see limited signs that actually production has been cut, according to your own numbers, guys. But at the same time, it's too early. We're still only in January.
This gets us to a broader question, too, when we talk about the balance between supply and demand. And I guess, how should I put this? The idea that some of what we've been seeing over the last year has maybe been a little bit artificial. The idea that prices have been sort of bumped around. You have, of course, OPEC plus members who would like to see them higher. You have an administration here in the U.S. that's done everything it can to try to keep them lower here. When do we get, I guess, a purer market, if will, or is that just kind of a fantasy?
Yes, if you just look at the numbers, it's demand is not an issue. Yes, it has nothing to do with the administration or with the OPEC countries. It's post-recovery, yes, post-pandemic recovery. This year I plan to travel significantly more than last year, so that's where the demand is coming from. But at the same time, the 2 years of very high oil prices in the hundreds, yes, 2021 and 2022 did exactly what they were supposed to do. It's a commodities market. They incentivize supply. At this point, everybody is growing. United States last year increased by 1.6 million barrels per day. But on top of that, you have Guyana, you have Brazil. So non-OPEC supply, growth in non-OPEC supply is significantly higher than the growth in demand.
When you look at I guess, potential new supply coming onto the market, meaning you mentioned Guyana and the big oil field there, and there are a few other pockets here and there. How much is that going to change the equation, or is that just going to balance out some of the legacy, if you will, to some of the legacy areas that have been the main focal points of supply?
To some extent, it's the legacy, but it's all growth.
Yeah.
So if you look at the numbers for 2024, 2025, and for 2026 as well, there's a significant amount of growth coming from the deep water production. Why is it so important? It's because it's cheap. It's price inelastic. Production in Guyana is between $30 to $40.
Yeah.
So this is a cheap, and regardless of what the global price is doing, they will continue producing just because they're price inelastic. So this is the new capacity.
All right, Natasha, great to have you here on the program. Natasha Kaneva there, head of global commodity strategy at JP Morgan. Coming up here on the program, earnings from the $3 trillion empire. We're going to preview what to expect before Microsoft reports after the bell tonight. That's coming up next here on The Close. This is Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with the large cap banks here in the U.S. Morgan Stanley upgrading the group to attractive. That includes Citi, Bank of America, as well as Goldman going to overweight. Analyst Betsy Gracek more optimistic now that increased capital requirements around that Basel endgame appear to have been scaled back. Gracek saying this opens the door for a significant increase. Some of those corporate buybacks, those shares, including Goldman, up a couple percentage points on the day. Next up, let's take a look at Jack Dorsey's fintech company Block on the receiving end of 2 upgrades today, and that includes to a buy recommendation over at BTIG. The analyst praising Block for balancing the needs of both consumers and merchants, and more integration between the Cash App and Square wouldn't be such a bad idea after all. Nevertheless, the share is moving lower here on the day by almost a percentage point. And finally, Advanced Micro Devices set to report earnings after the bell tonight and getting cut to outperform from strong buy over at Raymond James earlier today. The analyst attributes the downgrade to elevated revenue expectations tied to the AI GPU unit, and he notes such a rapid share gain is less common in data center, and it could attract a more aggressive competitive reaction from rivals like NVIDIA. AMD shares taking a big leg down today, 3% lower, and those are some of our top calls. All right, let's stay in the tech space and let's finally stay with AI. Microsoft set to report earnings after the bell later tonight here. It started off the year by joining the $3 trillion club and topping Apple as the most valuable company in the world. Today, we're going to get a better picture of how AI and cloud computing played a role in driving sales growth and driving that valuation up. Tyler Radke joining us, director and co-head of U.S. software over at Citi. He's got a buy rating on Microsoft. And let's just start off. The numbers themselves, we'll get to that, Tyler, but everybody is going to really be looking at the AI story here and whether the growth, material growth in that AI business is enough to justify the valuations. What do you expect?
That's right. I think we've been looking forward to this print for a while. They're reporting about a week later than they normally do. So the anticipation has been building on this one, especially after the strong start to this year. I think what we're looking for is clearly strong results. We put out our thoughts ahead of the quarter last week. We run a quarterly reseller survey. We also supplement that with some channel checks. And I'd say the tone of the conversations were much more constructive than what we've heard over the last few quarters. Now, clearly the bar is high. We are expecting the Azure business, which is the cloud consumption business, to reaccelerate this quarter. We also are looking for some commentary on Copilot. So that is one of the big Microsoft AI product releases. It came out in November. We're looking for some commentary or some disclosure on the number of users. Ultimately, we think that and some of the other new product revenues can drive an acceleration in total revenue and earnings power as you get into the second half of this year. So there's a lot to watch out for, but we're constructive heading into tonight.
I'm curious. I mean, it's interesting. Obviously, a lot of focus on Copilot, also a lot of focus on M365, basically the Office suite, of the updated version of that, of course, that we're told is going to include a lot of these developments that they've made on the AI side.
Yeah, that's right. So and Copilot is such a broad term now. I mean, they even talked about adding the Copilot key to the new Windows devices. But specifically, you have Copilot for Microsoft 365. Again, we're thinking you could see a user number reported around 1 million. That's kind of what we're looking forward to. And then you have GitHub Copilot. So this is the Copilot that's assisting developers. It's doing code completion and really helping developers become more productive. We think that's probably doing the best out of all the Copilots. You have some higher priced packages coming out in the coming months. And then you have the Copilot just around the overall search business, which I think that's a bit of a longer term play, more geared towards the consumer.
And of course, Tyler, you attended Microsoft's AI tour recently, and you noted that there are some customers who pointed to sometimes what you call prohibitive pricing. What does that mean, and what does that say about customers' willingness to pay up for what Microsoft is selling?
Yeah, it's a good point. So that was a specific comment that we picked up related to Microsoft Fabric. So Microsoft Fabric is their updated data and analytics platform. They actually released this out at Build in May of 2023. And essentially, this is taking all of Microsoft's services that they have under the data and analytics category. So things like Power BI, Purview, things like Synapse, which is their data lake. What we heard from customers was, hey, if we're already paying for these services separately, there is an additional upcharge. There's a consumption upcharge. So again, this is anecdotal commentary. Some customers thought that it was a little bit too expensive to go with Microsoft Fabric. Again, that is separate from the generative AI and separate from the Copilot discussion, but it was something we did pick up.
Yeah, something notable too, given the inflation trends that we've been seeing and customers' willingness to pay for increased services. I do want to get your take on the FTC action on Microsoft and Alphabet. I know that you're expecting good things for this quarter, but how concerning is Lina Khan's investigation or inquiry into the partnerships that Microsoft has formed with OpenAI and what could come out of that from where you sit?
Yeah, look, I think that like any technology wave we've seen in the past, the regulations are always something to think about. And so I think with generative AI and specifically OpenAI, where Microsoft kind of has this leadership position in this big technology category, I think the ground rules have to be laid out. You've seen some of the back and forth, whether it was the New York Times, just this question of intellectual property, how ultimately these business models evolve, I think is something to watch going forward. It's difficult to say what the regulators are going to do. Certainly, we've seen them block some acquisitions, whether it was with Adobe and Figma. That being said, Microsoft and Activision did go through, but overall, something to watch, but I think in the near term, we're not too concerned about it. And even if the Microsoft and OpenAI relationship were to change, Microsoft supports tons of other models, whether it's open source models, Mistral, Llama.
Right.
So we think they're well positioned even without OpenAI.
All right, Tyler, really appreciate your joining us. Tyler Radke over at Citi has a buy rating on Microsoft, which we'll be reporting after the close. And Romain, the big question here is what it says about Copilot, what it says about AI, whether it actually puts any numbers to all these lofty expectations.
That's what I want to see, because look, we know there's promise here, but what's the bottom line? At the end of the day, investors are fundamental, and at the same point, they got to show some fundamental returns.
All right, coming up, we're going to speak with Al Guido, president of the San Francisco 49ers, as his team prepares to go to the Super Bowl. This is The Close on Bloomberg.
.30 here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu, and we're 2 weeks away. Almost 2 weeks away from a certain game.
Yeah, I'm told it's the big game. Are we allowed to call it the Super Bowl?
Yeah.
Okay, I think that just cost us like 500 grand right there. But this is going to be a big deal. I believe you are a San Francisco 49ers fan, or I'm told, as you told us.
I married into it, so it wasn't by choice.
Facing off against, we should point out, not only the reigning champions, but of course, the it couple of the year.
Yes. And we'll get to that in a moment. But, tickets for this event in Vegas are the most expensive ever for the big game. We're talking about an average $9,800 a piece, according to reseller TickPick. Huge jump from the last time the Chiefs and the 49ers battled in the 2020 Super Bowl. So I'm thrilled to say joining us now is Al Guido. He is president of the NFC champions, the San Francisco 49ers. Al is also CEO and chairman of the sports and entertainment agency Elevate. Congratulations and welcome.
Thank you so much. Appreciate it. Thank you for having me.
Before we get started, be honest, how nervous were you when the Niners were down 17 in the third quarter? What was running through your head?
Really nervous. My Oura ring alerted me to my stress level, to be honest with you. I had to spend time consoling. I have 3 daughters. I was spending time consoling 2 of them who were in tears about what was about to happen. But it was a great second half, and we're lucky to come out on top.
And they kept their faith, so it all worked out in the end. If sport franchises are brands, and the 49ers are one of the most storied brands around, a brand's value, of course, is tied in large part to the value of its followers, its fans. So I'd like to get from you some sense of the numbers on this size, the depth, the reach of your fan base, the faithful, that sponsors like Levi's, which recently renewed its stadium renewal rights, naming rights, are paying for access to. Can you tell us a little bit about them?
Certainly, and I think the world it continues to shrink every single day. And so when I got to the team in 2010, I think about we weren't in Levi's Stadium yet, but the reality is most of us in the sports world, call it 15 years ago, thought about only the 10 games we put on. And the reality is that's only 700,000 fans. Our global fan base is 15 million people plus. And now with the NFL and what they let you do in international markets where they give teams the rights to be able to sell sponsorships in those markets, whether it be for us, the UK and Mexico, and frankly, Levi's provides us a platform, Levi's Stadium that is, provides us a platform we didn't have in Candlestick Park, where we've done over 155 events in the first 10 years there. We've done $2 billion in economic impact, 12,000 jobs. And so I think the world really shrunk quite a bit, coupled with the fact that sports media post-COVID has certainly skyrocketed. We thought it might have been a COVID bounce. It's just here to stay. Live sports and entertainment is really what people are consuming on a daily basis, and the 49ers are thankfully at the forefront of that.
How much does the Super Bowl appearance change that, or elevate that, I should say?
Dramatically, and we've there's no question. I mean, I can put certain metrics to it. You've seen it already. I know on the Chiefs side, they've seen the Taylor Swift media phenomenon around $300 million plus in earned media since she's really been part of that team.
Are you jealous of that? Are you going to your players and saying, "Where's your Taylor Swift"?
Listen, we have.
Brock Purdy, he's a handsome guy.
We got great storylines on our side of the ledger. You're right. Brock's a great storyline. McCaffrey's a great storyline. But I think, to me, this game is certainly about the two teams. Yeah. But I think it's a little bit about where the NFL sits today in the broader sort of ecosystem around sports, entertainment, pop culture. Yeah. All of those things converge, and it just so happens to converge in Las Vegas.
Well, that's a big deal, and I bring it up sort of tongue in cheek, but I mean it's a big deal. As you know, a lot of people watch the Super Bowl who have no interest in football during the regular season, and it brings a lot of people in and exposes a lot of people to the team and the players and the whole brand in a way that you just can't get unless you're really on that big stage.
No, you can't. And in discussions with Levi's, you mentioned in the lead-in that we were able to, it's unprecedented. We signed a 20-year deal with Levi's when we opened up the stadium. We still had 10 years left on that deal, and they extended for another 10, so taking it to a total of 30 years. So they're our naming rights partner through 2043 at an increased value. So, that doesn't necessarily happen in aging stadiums, but for us it happened because of the popularity of our sport, the popularity of our team, frankly, the venue itself, and now our geographic footprint, which has really changed because the reality was we were only able to sell what we call rights and marks, or the Oval, in our case, the 49ers Oval, within a 75-mile radius of our building. Now we can sell that to whoever. So the exclusivity of a partnership is both in the Bay, but in the globe as well.
We mentioned Taylor Swift. I have to go back to that for a moment because we talked about the $330 million added value that she offers the Chiefs. How did the 49ers capitalize on that? Or is it too messy given all the conspiracy theories out there? The NFL's rigged, the Super Bowl's rigged, all of that.
I think the NFL, as a culmination, we all benefit from, frankly, Taylor or the next storyline because it increases our media value, it increases the general fan, as you mentioned, that might follow the game. And the reality is we benefit because those people are tuning in. If they're a casual fan, they're tuning in around the storylines. They might be tuning around Usher at the halftime. And what we hope is that at the end of that, by playing in these marquee events, if you think about what happened with the San Francisco 49ers in the late 80s and early 90s and how they became America's team because of 5 Super Bowls and Joe Montana. Well, that is our moment. And we have 2 weeks really now to seize on that moment. And look, it would certainly help if we're standing there holding our 6th Lombardi trophy. Yeah. But it's great for us that Brock Purdy and Patrick Mahomes are in the same sentence. It's great that the San Francisco 49ers are in the same sentence with Taylor Swift. Like, these are good things for our brand, and we're going to lean into them as much as humanly possible.
So, Al, what's the next 2 weeks going to look like for you and the organization? What do you have to get done?
We got so much to get done. I mean, it starts off with getting our team there and making sure logistically we're all set and ready, because when you're not participating in the Super Bowl, it's about everything else outside the game. When you're participating in the Super Bowl, it's about making sure that the players are ready, that their families are ready to play on Sunday, because that is our lone main goal, is to go out there and win our 6th Lombardi trophy. So we're literally, I missed an all-staff meeting today to talk about all of our staff, all their families, the 6 different large planes that we're going to take there to bring every single one of our partners to Las Vegas and the logistics behind that. But it takes an army to put these events on. Thousands of people are going to be working on our behalf, volunteers from, frankly, all over the Bay to do so. And it's going to be a lot of fun.
All right, I need to get your prediction for what the score will be at the end of the Super Bowl. Come on, what is it?
I don't want to predict. I think it's really fascinating. George Kittle has this very popular clip in 2019 where he's standing on the sideline at the end of that game after losing to the Kansas City Chiefs and says, "I'll be back here, and I'll be back here with a vengeance." We're going to win a Super Bowl. I personally don't care what the score is at the end as long as the 49ers are on top. Let's hope that's the case.
All right, well, we wish you well. Al Guido there, president of the San Francisco 49ers. You can check them out versus the Kansas City Chiefs on February 11th. All right, we do want to turn back to geopolitics here. We do have some breaking news involving Saudi Arabia and their discussions that they've had been having with the U.S. Defense Department. Those discussions had been put on hold because of the Hamas war. We're now learning that the Saudis have now re-engaged with the U.S. Defense Department, resuming talks about forging closer defense ties. Again, that's after a pause following the start of the Israel-Hamas war. We're going to get you some more details on that and get you more details on what's happening in the market with about 23 minutes left until those closing bells. This is Bloomberg. UPS reducing costs in order to save about $1 billion, even if that includes cutting 12,000 management roles. Shares of the company down about 8% here on the worst day they've had going back to April of last year. This after reporting a 9% drop in annual sales. It was a disappointing forecast that missed analysts' expectations. Lee Klaskow joining us for more, senior logistics analyst for Bloomberg Intelligence, to talk about sort of, I guess, what's really ailing UPS. I mean, not just that the revenue was down, but you look at the labor costs, at least the union labor costs were up pretty significantly in the most recent quarter as well here. What more can they do? They cut a ton of jobs last year and now 12,000 more management jobs. Is that going to help?
I mean, I think every little bit helps. The $1 billion that they save on costs is about 90 cents in EPS, so every little bit costs. And what they're really doing is looking at the structure of their networks, whether that is their labor network and then their management ranks. They're looking at their brokerage business. They've decided to put that under strategic review. That business is called Coyote Logistics. It's the third largest freight broker in North America. That business could be sold. We've seen them sell other businesses in the past since Carol Tomei has taken over as CEO. She sold the less than truckload business a couple of years ago. And I think we're going to hear more probably about structural changes of UPS when they have their analyst day later in March. So I think they were kind of saving some other announcements for that event again in a couple months from now.
I mean, these are big numbers, 12,000 jobs. How much of this do you think is structural versus cyclical, meaning people will be hired back once package volume picks up again?
Yeah, so it's about 14% of their management and contractual ranks, and it's full-time and part-time employees. So we really don't know what the breakout is going to be in terms of full-time and part-time folks. But what it is showing us is that they're taking a hard look at their costs, and we would probably have to say UPS and some other large transportation companies have gotten fat over the years, and this is a time to recalibrate their overall network. And the kind of resources that do to supply that network, because as technology advances, people are being able to do more with less, if you will, because of the productivity gains that you're getting. And I think we're also coming off a time where there was a labor shortage during the pandemic, and a lot of companies, UPS probably included, overhired. And now because demand is pretty tepid, they're expecting a small package volume growth to be around 1% this year, with kind of declines in the first half and increasing in the second half. And obviously, when you're talking about the second half, that there's more risk to that estimate given the time horizon.
Yeah. I want to focus a little bit more on the revenue side of it. I mean, even the guidance they gave, I think the top end of that range was around about $95 billion. While that's short of estimates, it's still a pretty healthy number. And I am curious about sort of the mix in that business. I know they're a little bit less dependent on things like Amazon. They found sort of other avenues of revenue that maybe have higher margins here. When you look at that forecast, A, do you think they'll meet it? And B, do you think they'll meet it in a way that will be profitable?
Yeah, so so the B2B business, so the business to business, the business to business volumes tend to be a higher margin than the business to consumer. So when I say business to consumer, I'm talking about a package being delivered at your doorstep, because the cost per package for that delivery is a lot more than if a UPS driver goes to a law firm with 50 envelopes in hand. That cost per delivery is a lot less. What we're seeing is that part of the market doing a little better than B2C, which is good for margins. The mix, I believe, was 29 or 30-something% for the B2B business, and that's been increasing. And they've been focusing on the smaller to mid-sized shipper, which was around 29% of their overall volumes, and that business segment tends to be more profitable. Versus the large customers like Amazon, which accounted for 11.8% of revenue.
All right, Lee, really appreciate it. Lee Klasko of Bloomberg Intelligence. And Romain, I think it's really hard to be someone that relies so much on Amazon. They drive a really hard bargain. It's like being a supplier to Walmart.
Yeah, that was kind of the devil's bargain, right? They made a lot of money off them early on, but once Amazon grew and they got all the power, they saw that it was just maybe a deal that they would like to not to necessarily be a part of.
Absolutely. Coming up, price earnings innovation. Our next guest coined the term and says it's the most important thing investors need to watch out for. Sherry Paul of Morgan Stanley Private Wealth Management joins us next. This is The Close.
This is the countdown to the close. Romain Bostic alongside Scarlett Fu. Just about 10 minutes until we get to the closing bell, Scarlett, here. And I don't know, that holding pattern we've been in, still a hold here.
Yeah.
People are waiting for something.
Literally, the S&P 500 is flat. It's unchanged. The NASDAQ is down about 2/3%. And it's all about earnings from Microsoft and Alphabet. Over the past half year, Microsoft and Alphabet alone have accounted for more than 1/5 of the S&P 500's rise, even as the consensus for estimates for this quarter, the quarter they'll be reporting, have barely moved. So you wonder what that means.
Yeah. Interesting, though, that some of those estimates for the quarters on the outlook are going up. But of course, a lot of that has to do with AI and whether all that hype actually feeds into the fundamentals. Maybe they'll talk about that. Satya Nadella, he's got a lot to explain here. There's a lot of drama going on behind the scenes there. All right, no drama behind the scenes here. Sherry Paul joining us here in Studio 2, private wealth advisor and senior portfolio manager at Morgan Stanley Private Wealth Management. Sherry, great to see you again.
Great to see you.
Let's start with Microsoft, since Scarlett was just talking about it here, because it does seem like it's going to be representative, for better or worse, of the broader tech space overall. This has been the driver of the market. It was last year, and to a certain extent, it has been this year here. But a lot of that seemed to have been based on valuations that were really about hopes and dreams and the promise of something that, at least for right now, is not here.
Well, you're speaking my love language with hopes and dreams.
Okay.
So without being company specific, I think what's interesting about earnings of all of these big tech companies right now is they represent the concentration of how we got into a dominated narrative where a few companies are really leading the discourse around innovation, alternative ways of doing business, and what the ecosystems need to produce this new way of being in an emerging economy that more and more feels very much like an industrial revolution. So I would expect that these companies continue to be the dominant voices and so have dominated performance and earnings within the S&P 500.
Yet, when you look at them using traditional valuation methods, it would seem that they are overvalued by a lot. PE ratios kind of have them trading up here while the S&P 500 is down here. You've talked about moving on from PE ratios to price to innovation. Is that the same thing as the PEG ratio? Price to earnings growth?
What I'm suggesting is that we expand our thinking, including our existing toolkit, to add a different possibility that as we're innovating into this new territory of innovation, which is AI, which will have a dramatic impact on how humans work. It's a cost savings, productivity enhancing revolution that I refer to as this is a cost cutting bull market that we're beginning. Every bull market kind of has its own flavor, and this one is about productivity enhancement. And so when we think about beyond price to earnings ratios, we have the PEG, price to earnings growth, which then accommodates for a higher PE that then can be, the valuation can be sort of modified based on a growth projection of a company.
Okay.
That's based on an existing product or activity that then is expanding and growing. Innovation, though, by definition, if you like look it up in a dictionary, is the idea that something that hasn't been here before becomes something of tomorrow, and I'm not quite sure that we fully priced in what that could be.
But how do you do that?
I know.
I mean, because we're talking about a hypothetical, and I remember, I don't know if it was a couple of years ago, who sort of really shepherded this, but there was a lot of talk about intangibles in terms of what was on the balance sheet and how it wasn't really reflected there because of the way of accounting. And obviously, intangibles are a little bit more tangible than what you're talking about, but it's still the same concept.
Well, it's the same concept, but listen, I'm a math and science investing person as a portfolio manager. Right now, my bigger message to investors is to really focus on the value of the 493 stocks that missed out on this rally in a market dominated by the big seven, a number of which that you just mentioned. And so there's plenty of opportunity in sectors like healthcare that basically had a flat year, that's also using innovation for vaccine, innovation that should be earnings expansive, manufacturing, industrial. These are cost-saving places that people should be really focusing their portfolios beyond the capitulation trade, which is just buying the index, which is top heavy. All right, that's a very different message. The innovation part of what we're talking about is more the inspiration of really what's happening here, and
except that we don't have any firm numbers around that. I mean, that's what we're waiting for.
No, the math
in about 20 minutes is to get some firm numbers around the innovation that you talk about. And there's a very cynical way of looking at innovation now these days. People don't necessarily think kindly upon it because it's a job killer.
Well, it's a job enhancer. And it certainly is
eventually.
Eventually. But, remember, earnings are a moment in time. They're not a theme.
Yeah.
And so when we talk about innovation, we're really talking about thematics. But yes, the math people get unended by this because it's in arrears, right? Like, this is forward-thinking activity where we're living in a world that most people 30 years ago couldn't even imagine. My oldest client is turning 99. I've known her for 30 years. The things that she's seen, if someone told her that someone was going to talk out of a box, it was a radio. She told me she got grounded from her mother because she was accused of fibbing. That's what innovation is. Does that make sense?
Does she believe in a price to innovation multiple then?
I've asked her about how come she's lived so long, and her advice to me was that you do what you can and you can the rest. And I took that to heart, meaning that where the mind goes, life does go. There are lots of different corridors that we could take investors down right now. I am very dedicated to giving people the corridor of opportunity in a transformative moment of innovative thematics that are going to be an investor's dream for a lifetime. This is different than 2000, in my opinion. 2000, there were no earnings. This is an enable and an install in current systems with real earnings. It's a very powerful moment in a traditional sense, too.
But can I push back on that? Because I've heard this argument before that it's different than the bubble, because during the bubble, you were really dealing with companies that had no real track record. I understand that.
We had a 27 times earnings on the market, too.
Right. And I understand that Microsoft and NVIDIA's of the world, they have definitely a track record in terms of corporate fundamentals here. But at the same time, we're talking about whatever AI adds to that. And I have yet to hear one of these companies, with maybe the exception of NVIDIA, really articulate the math of that and how that's going to work. But you're saying that shouldn't matter right now? Or?
No, I'm not saying that at all. Okay. What I'm suggesting is that right now, my central point for investors is to follow the math and science of investing. Despite this idea that somehow we have an expensive market. Right now, if you take the top 7 stocks out, you get a P of 17. You've got terrific companies that are deploying this technology, though, in a very cost savings way, in a practical way that's meaningful and has real earnings. This isn't, and that is the innovation, is how to cost save through the deployment of this tech, is my point.
All right. Well, Sherry, you made the point very well. Always a great conversation with Sherry Paul, Private Wealth Advisor and Senior Portfolio Manager at Morgan Stanley Private Wealth Management. All right, we are counting you down to the closing bells here. Just a little more than 2 minutes to go here. The S&P basically unchanged on the day. The NASDAQ down 1%. Stick with us. We're moving closer to those bells and our full market coverage. It starts right now as we take you to the bell and beyond.
Beyond the Bell Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Look at that. Hi. Bringing together our Bloomberg audiences across all of our platforms, television, radio, originals, and our partnership with YouTube. Here on a very busy day for earnings after the bell, we get quite a few companies, including Microsoft, Starbucks, and Alphabet.
Yeah, just a few big ones. That's certainly going to be our focus point after the close. But I feel like today, the focus during the regular trade was all about what we saw in the rate moves, and that stronger than expected jobs report in terms of job openings. I think it's just a reminder that this is some of the challenges the Fed has to deal with. Great that people are working. Great that, that's a good sign. But also it just shows to some of the heat that remains in the U.S. economy.
Yeah, I mean, everyone's kind of standing back and waiting for what we see after the bell today. Really what we hear from the Fed tomorrow. I mean, Jay Powell certainly has his work cut out for him. I mean, in terms of, he's going to be asked a lot of questions about rate cuts, and we're going to try to get some understanding of what the Fed is thinking. But it's still, I still think, guys, that the market is pricing in more than what the Fed is actually going to do. It just seems to be the sort of the message that's emerging.
Especially when the economy has held up much better than so many people had anticipated, and by some measures, what everyone had anticipated. So it's an open question how much Jay Powell pushes back on the market pricing for at least 5 rate cuts this year.
Yeah, I do want to go back to that JOLTS data, too, because when I saw that number, I mean, I definitely saw the reaction that you saw, Carol. But then when you dive into it and you look at how the quits rate had kind of eased a little bit, and the idea that there are some signs here that the mobility that we had in the labor market that was a hallmark of the strength over the last couple of years might be waning just a bit. Let's get to the numbers real quick here before the earnings drop. The Dow Jones Industrial Average going to finish the day higher by 140 points, or about 0.4%. The S&P 500, we're just going to call it unchanged. It's down about 3 points as we wait for the numbers to settle right around 49.25. The Nasdaq Composite down about 118 points, or 0.8%. And the Russell 2000, guys, down right now by about 0.8% here on the day as well. And I believe we have some breaking news, guys, on Nasdaq. Who wants to read it?
Yeah, I'll get to that right now. NASDAQ is planning hundreds of job cuts, and this is as it integrates Adenza. So once again, NASDAQ planning hundreds of job cuts right now. And of course, this comes out as the market closes, so we don't have a market price reaction for you right now.
Okay, so we got UPS, 12,000 jobs today.
Yep.
12 to 14% of management.
PayPal.
PayPal earlier.
Hey, I'm going to interrupt you.
Yeah, go ahead.
Microsoft earnings crossing the wire right now. Their fiscal 2Q revenue number coming in at $62 billion. That is a slight beat. The street on average was looking for 61.14. Either your EPS number right around $2.93 a share. Not quite sure the comparison there, but that also does look like a beat. Intelligent cloud revenue, an important one, $25.9 billion. That's roughly slightly higher than what the street was looking for at 25.3. Productivity revenue at 19.3, slightly higher than estimates. And your personal computing revenue number also coming in kind of on the nose at about 16.9 billion. Cloud revenue overall in the quarter, guys, 33.7 billion. The street was looking for 32.2.
Yeah, we're seeing the stock just a little bit change, just up about 0.6% here in the after hours. Had quite a run, as we know, Scarlett, last year. But, all in again in terms of investments in AI, their Office 365 Copilot product. We're looking for some of the specific details in terms of the ramp up. But really, some of those key headlines, that revenue, second quarter revenue, a little bit of a beat, 62, as Romaine mentioned, 62.02 billion versus the estimate of 61.14. And the cloud revenue, also a very important business to the company, that was a little bit of a beat too, 33.7 billion versus 32.2. Right now, the stock, though, pretty flat in the aftermarket.
Yeah, the cloud revenue is stabilizing, and that's what people were looking for. I want to jump over to Alphabet, which just reported as well. These are fourth quarter numbers for Alphabet. Revenue beating analyst estimates, $86.31 billion. Analysts were looking for $85.36 billion. When it comes to ad revenue, and this is a big one because that's the bulk of its business, $65.5 billion. That is less than what analysts had anticipated. They were looking for $65.8 billion. Cloud revenue, which is obviously a smaller part of the business as Google tries to ramp up and catch up to Amazon and Microsoft, $9.19 billion. Analysts were looking for $8.95 billion. EPS, the bottom line, $1.64, Analysts were looking for $1.59. When you back out the revenue passed on to partnering websites, Alphabet's fourth quarter revenue was $72.3 billion. Analysts were looking for $70.97 billion.
Okay, shares down about 3.7%, bouncing around in the after hours right now. Want to go to the press release and look at commentary commentary from Sundar Pichai, the company's CEO, who said, quote, "We are pleased with the ongoing strength in search and the growing contribution from YouTube and the cloud. Each of these is already benefiting from our AI investments and innovation. As we enter the Gemini era, the best is yet to come." Certainly going to be a lot of questions around AI, but the company is already unveiling some of that AI in its core products. If you've noticed, when you're using Google search, you see AI returning results for you already.
And this is really the big story. I mean, I'm glad you mentioned Gemini. We were talking a little bit earlier on the TV program about Microsoft's version of that Copilot here. And the idea that all of the hype that we saw around that last year and all the tinkering with the search engines and things like that, the real monetary story, the idea that you could actually see some accretion to earnings and, of course, to revenue as well, is probably going to come from the wider release of Gemini for Alphabet and Copilot for Microsoft.
All right, so let's stay with Microsoft for a moment because the stock is down about 0.8%, just slightly lower in the aftermarket. The press release coming from Satya Nadella, of course, the CEO of Microsoft, talking about we're moving from talking about AI to applying AI at scale. By infusing AI across every layer of our tech stack, we're winning new customers and helping drive new benefits and productivity gains across every sector. So certainly some optimism there. But right now, again, Microsoft down about 1%, guys.
We should also mention there's a headline here saying that Microsoft will provide forward-looking guidance on call. So I assume that means something to the extent of how many people have signed up for Copilot on Microsoft 365, trying to give some numbers and quantify all the excitement, all the hype that we have around the AI offerings that Microsoft is putting out there. And, you can't do that by just providing numbers without any kind of basis of comparison. You kind of have to talk through where you came up with those numbers.
I think there's still a lot of questions for both of these companies about the way that AI actually trickles down to the bottom line, Romain. I mean, you can integrate these products in search. If you're Alphabet, you can integrate these products into PowerPoint, for example, and make it really easy for someone to use PowerPoint. But to what extent does that actually make more people sign up for this stuff? To what extent does it actually drive new business?
Yeah, hold that thought.
Go ahead.
Yeah, Starbucks crossing the wire.
Yeah, we all need a cup of coffee here. All right, so let's get to Starbucks. First quarter comp sales, always a key number here. It's up 5%. The estimate was for a gain of 6.4% essentially. First quarter adjusted EPS of 90 cents. That's 3 pennies shy. Listen, folks were expecting some problems here for Starbucks. You're seeing weaker store traffic.
This is a big problem, though.
It is, and the stock's down about 1.3%.
China comp sales, 10% growth. The street was looking for 16. International comp sales, 7. The street was looking for 12. North American comp sales, 5. The street was looking for 6. I mean, what am I missing here? Are they selling coffee or are they not?
Well, they're not. I mean, there's a long-term concern for what they're doing in China and that company. You've had boycotts in the Middle East. You've had boycotts and concerns in different parts of Asia. And so you're seeing a big pushback, certainly across the board. But you're right. Those are some pretty strong numbers. And you got Starbucks down about 3% here.
Let me just jump in with Mondelez because that company, the food and beverage packaged food company, has also reported fourth quarter EPS, adjusted EPS, 84 cents, beating the consensus estimate of 78 cents. Net revenue in the quarter, $9.31 billion, missing the mark. Analysts were looking for $9.34 billion. And when it comes to the operating margin for the fourth quarter, 15.1%, also slightly lower than what analysts had anticipated, which was 15.3%. In terms of the outlook, 2024 organic net revenue will be an increase of 3 to 5%. Even at the high end, that misses the consensus estimate of 6.6%. Mondelez right now unchanged in after-hours trade, but we'll continue to keep an eye on that trading.
And that's a little bit of a surprise because people have still been snacking, but some of the concerns are some of the higher costs, whether it's cocoa or other input ingredients. But I think there were expectations that these numbers would be a little bit rosier, and obviously they're not.
I just want to briefly touch on EA. Shares are flat in the after hours, but we did see net bookings for the third quarter come in above estimates. We saw third quarter adjusted EPS come in slightly above estimates. The company sees fourth quarter adjusted EPS coming in between $1.25 and $1.75. Estimates are for $1.57. So within the range of estimates. Again, shares not moving in the after hours.
Yeah, it's kind of interesting, this mixed bag. I just want to go back to some of the big ones. We still have Microsoft just down about 0.8% here in the after hours as we continue to, I think the expectations, right? We saw a tremendous run up in these names in 2023. We have have a lot of guests we just had on that are saying, well, wait a minute, are those valuations that we see on something like a Microsoft or an Alphabet, are they justified? And I think that's what investors are trying to figure out on some of these releases.
Well, we were just talking with Sherry Paul over at Morgan Stanley Private Wealth, who's kind of raising this whole issue of price to innovation as kind of a metric here. The idea that you take some of that intangible innovation and you sort of ascribe some real value to it. And maybe that means evaluations aren't as stretched here, but at least based on the share reaction in after hours trading, I don't know. I think more investors, at least for today, are more aligned with you, Carol.
Yeah, Alphabet down about 4% here still in the after hours, and you're seeing Starbucks bounce around. All right, guys, that's a wrap. A lot of earnings here in the after market. That'll do it for our cross-platform radio, TV, YouTube, and Bloomberg Originals. I know you guys are going to continue talking about it. We will too, but we will see you all together tomorrow.
And we continue our coverage right here on Bloomberg Television, a deeper dive into some of the big earnings that we just got, including Starbucks, EA, Alphabet, and Microsoft. AMD also on deck. Don't go anywhere. Full coverage coming up right here on The Close on Bloomberg.
All right, Microsoft reported earnings right after the market closed, and we did have a revenue beating analyst estimates, the bottom line beating analyst estimates as well. But the stock is falling in after hours trading. Let's get more insight now from Anurag Rana. He is Bloomberg Intelligence Senior Technology Analyst. In terms of the numbers, it looks like Microsoft delivered, but perhaps not by as wide margins as maybe investors had expected, given the movement in the stock up 8.3% so far this year.
Yeah, I would say broadly their results met expectations to slightly exceeding them. But the big factor with Microsoft, as it is in almost every quarter that we follow, is what's going to be the guidance for next quarter. I think that's really the most important part right now, because what we are seeing after 2 quarters of stabilization in cloud results, now the question is, do they pick up or not in the second half or the second fiscal half for Microsoft?
What actually causes that pickup, Anurag? I mean, what do they hang their hat on?
Yeah, there are 2 factors. One of them is companies or corporations who have been cutting back on cloud spending for the last 1.5 to 2 years. They come back and increase their cloud consumption. The second big key factor is increased contribution from AI workloads. So if you're going to use more ChatGPT, Azure makes more money on the back end.
So this gets us to a broader question here about the strategy around AI, the integration into the back office, the integration obviously into some of those forward-facing products like the whatever that new Office suite is going to look like here when they release it here. Well, where do you see the most potential for them to monetize this?
Yeah, Romain, for the next 12 to 18 months, the biggest contribution is going to come in Azure, Microsoft Azure, or the cloud infrastructure product. That's the back end of ChatGPT and other workloads. After that, we expect to see more contribution from these Copilot products that you're talking about, because they just came out. There is a big base. It's going to take some time for them to contribute. But we are very optimistic that in the long run, Microsoft is probably better positioned than any other software company out there to capitalize on this increasing demand for Gen AI workloads.
What would Microsoft have to say in the earnings call later on that would restore investors' faith that it deserves the valuation it has right now?
Yeah, so Azure growth came in at about 28% in constant currency. Microsoft guidance needs to be 28 and above for them to basically either recover or even stay slightly negative, because as you said, over the last several months, Microsoft stock has done fairly well, so expectations are high, and I mean all of that hinges on that Azure guidance at this point.
Anurag Rana, a breakdown of those earnings out of Microsoft. Let's continue the conversation and turn to Alphabet right now. Those shares down about 4%. Mandeep Singh, also of Bloomberg Intelligence, joining us right now to help break down the numbers on the revenue side. $86 billion in revenue, but I think a lot of people are focused on that ad revenue, which came in a little bit light.
Yeah, and when you look at the split of that ad revenue, it's really the search part that appears to be weak. I mean, the reason for that is obvious. There is impact from, GPT and Amazon and all this kind of searches that are popping up. I think the cookie deprecation, which is going to happen in 2024, is also having an impact, because you could see how that will affect Google's network line. So they report that separately. It's a $9 billion run rate. And that's where you are seeing the core search business, which has 50% incremental margin. And they beat on the margin side. So it wasn't weakness on the margin side, but the ad top line seems to be weak, and I think that's what's driving this.
And that has implications for other companies that rely on the ad market too, like Snap and Meta, which are weaker in after-hours trading as well. What's notable to me is that heading into this earnings report, the ad spending market was the part of the business that people were really optimistic on. So this seems a little bit of a surprise. People were taken aback by this.
Yeah, well, we saw an inflection in terms of ad pricing last quarter. So we had 6 quarters of negative ad pricing for pretty much all the digital ad companies. Last quarter we thought there was an inflection, but it looks like in Google's case, it's a question of volume and impressions growth, not ad pricing. Google still has the best ad pricing, but volume is getting hurt by GPT and all these alternatives that are coming up. And YouTube, I think subscriptions outperformed, but on the ad side, it was in line with consensus. So we didn't see that big of an upside.
All right, those shares are down right about 4% right now. I want to interrupt this conversation and turn to AMD. Those shares also moving lower here on the back of its earnings report, just crossing the wire right now. Revenue coming in at about $6.2 billion in the most recent quarter. A little bit of a beat there. The street on average was looking for about $6.13 billion. Operating income for the quarter at $1.4 billion. That's a little bit light than what the street was looking for. Operating margin also coming in slightly light at 23% versus forecasts on the street of about 23.2. But the company is saying here in the press release that it is positioning Scarlett for a strong product ramp in 2024. The company also giving a first quarter revenue forecast. The range, Scarlett, 5.1 to 5.7 billion. The top end of that range is below the average of street estimates.
Yeah, that's interesting that the revenue forecast is a little bit lighter than what analysts had been looking for. It's worth noting, too, that in the fourth quarter, AMD had CapEx of $139 million, much more than what analysts had been looking for, which was just under $121 million. So the operating margin for the fourth quarter was also slightly below what analysts had been looking for, 23% versus 23.2%. Of course, AMD seen as kind of the next best bet on AI chip makers, right? After NVIDIA. Whatever NVIDIA can't fulfill, AMD can.
All right, AMD shares are down a bit here. We're going to dive a little bit deeper into those numbers. We do want to go back, though, to Alphabet. Those shares also moving lower. Mandeep Singh still with us here. And Mandeep, I am curious about the cost side of this story here. All these big tech companies so far, we've heard about cost-cutting plans, whether it's shutting down divisions, getting rid of jobs, or just finding a way to tighten the belt. Are we going to see more of that out of Alphabet?
I think so. And you see that already in their margins. Margins did exceed expectations. And I would call out cloud margins. Actually, cloud margins came out almost $400 million more than consensus. The reason for that is all the GenAI workloads are expensive to run. So it's going to hurt the search margins, but it's a benefit to the cloud margins because a lot of the workloads are getting deployed on their cloud. So you will see that accelerated ramp on the cloud side, but clearly search is the cash cow, and if the margins are getting hurt, it will have a bigger impact on the overall business.
Search is the cash cow, and search kind of disappointed in the fourth quarter. Google Cloud revenue did beat analyst estimates, unlike the previous quarter where Google Cloud was kind of the disappointment that dragged the stock lower. What do you need to hear? What do investors need to hear from the company when it comes to the cloud business to kind of restore their faith that Google is continuing to gain market share on Microsoft, on Amazon?
Yeah, I mean, it's the smallest player in terms of the size when you compare to Amazon and Microsoft, and you want to see acceleration from this point on. You're right, last quarter we saw a dip, sequential deceleration, but the acceleration we saw should continue, and they want proof points around that.
All right. Once again, Alphabet shares are lower in after-hours trading as the ad business seems to have missed the mark a little bit when you compare to analyst estimates. Mandeep Singh, thank you so much. Mandeep Singh, Senior Technology Analyst over at Bloomberg Intelligence. Now, coming up, we've got more earnings coverage. We're going to get insight from Doug Clinton. He is managing partner of Deepwater Asset Management. We'll talk to him about Microsoft, Alphabet, and AMD. This is The Close on Bloomberg.
All right, three big tech stocks under pressure here in the after-hour trade. Alphabet out with earnings here, and a big disappointment there on some of the revenue growth. Microsoft revenue did top estimates there, but some of the growth in the cloud business disappointing. And AMD just crossing the wire here, second biggest maker of computer processors, also giving a relatively weak forecast for the current quarter. Doug Clinton joining us right now for a deeper dive into some of these earnings. He's over at Deepwater Asset Management, a managing partner there. Doug, great to have you here on the program. I want to start with AMD, because there's been so much talk about chips and who was going to benefit from the chip race. We already know NVIDIA is, at least for right now, the king of the hill. AMD, a lot of people felt that AMD could maybe close that gap with NVIDIA. I'm curious as to what you make of today's report, and more importantly, some of the forward guidance.
They have the best shot to compete with NVIDIA of all the other people in the race. I think AMD really does have, with their new MI300 chip they announced last quarter, the best shot to give NVIDIA a run for their money. The weak guidance for next quarter, I mean, we just had Intel give a relatively, I would say, weak outlook and some weak commentary just a week ago. So maybe this shouldn't be surprising. We're really not going to see a huge ramp, most importantly, in that MI300 AI accelerator chip in the next quarter or so. So I don't think that that commentary is necessarily bad for the AI story. What I think will make or break the stock kind of for the rest of after hours is how they talk about the ramp for that chip later in the year.
Well, that's what I'm curious about, too. And it gets to a broader question, Doug, about whether investors still kind of have that same enthusiasm right now for AI the way they did a year ago when it really kind of came into the public zeitgeist.
I think they do. I mean, you look at a lot of these large cap tech stocks coming into the year. AMD, I think, was up almost 25% year to date just in the last month. NVIDIA was up even more than that last time I checked year to date. So I still think that people are getting on board with this AI theme. I think the question coming into this earnings, given the run that all these stocks have had, is will the earnings support some of the run? Will we get beats that maybe let people continue to just be unabatedly excited? And I think the answer with some of these quarters so far was, maybe it's time to pump the brakes a little bit, but I doubt that that's going to be the end of the AI excitement.
Yeah, this was the Super Bowl week for big tech earnings, and judging by how the stocks are reacting, at least at first blush, to these results, it seems like maybe people got ahead of themselves. I'm looking at Alphabet, for instance, whose ad revenue disappointed investors. It wasn't the cloud business this time, it was the ad revenue, which is its bread and butter. Microsoft not being very specific with its forecast, not giving any outlook for Azure. What does that tell you when there isn't as much clarity in the initial earnings release and they need to wait until the earnings call to really flesh out their outlook?
I think for Google and Microsoft in particular, Scarlett, that's something that we see more as common practice. So I don't read too much into that. But to your point about kind of the weaker rev look for ad revenue on Google, that I think was the most concerning part. If we look across all three of the names we're talking about, Microsoft, Google, AMD, I think that's the one thing that was maybe the biggest flag. And at Deepwater, we generally are long-term oriented investors. And so when we get a quarter, what we like to do is ask ourselves, has something changed fundamentally in the business, for better or worse, that changes our thesis on the stock? Even though that ad number was a little bit disappointing, for us, I don't think that that changes our mentality. It is a holding in our flagship Titan fund, and it's one that we still do believe in.
It's one that you still believe in, but does it give you reason to question what results for Meta, for Snap, for some of the other big tech companies that rely so much on advertising as Alphabet does, what those numbers might look like going forward?
Certainly maybe a little bit for Meta. That's one that we also own. And I think the market is probably starting to price a little bit of that in after hours now as well. The businesses obviously do have some overlap. Direct response is the majority of what Google does. Meta has a strong direct response business too, and some more brand as well. So I think that investors will probably be certainly more cautious heading into the Meta numbers. And maybe that is enough caution so that, even if that number is, let's say, in line, if we're just guessing, maybe the stock has a more neutral reaction.
When do we start to see, Doug, I guess a little bit of a warmer embrace of kind of the potential beneficiaries of AI that basically aren't named, Microsoft, Alphabet, Amazon, and NVIDIA and AMD, if you will? Because there's a whole universe out there. And every now and then I'll talk to some investor and he'll bring up some obscure company I never heard of. And then I'll look it up and I'll think, oh, he or she's got a real good point.
I mean, I love that question, Romain. And one of the things we do at Deepwater is we invest in both the public and the private markets. And the answer that we've been telling our investors is that I think a lot of those really exciting names that aren't named Google or Meta are actually in the private markets. There's companies like Hugging Face, which is sort of the open source, I'd say, leader where developers go to find those models and build on things like Meta's Llama 2 open source model with collaborators. So we're really excited about the private markets. I think it's a little bit harder to find public companies that do have really true, pure AI exposure that are in those smaller market cap segments that are also still high quality companies. So we've been looking on the private side for those.
All right, Doug, gonna have to leave it there. Great chat here, and we got to get you back soon. Doug Clinton over at Deepwater Asset Management. A closer look at some of the big tech earnings that we've gotten, and we're going to continue on this theme here for the rest of the hour. A deeper dive, of course, into what we heard out of Alphabet and some comments by the chief investment officer there over there. This is Bloomberg. Alphabet earnings are out. The shares are down. And just moments ago, President, CIO, and CFO Ruth Porat spoke with Bloomberg Technology co-host Ed Ludlow. Ed joining us right now. Ed, what did she say?
Well, the market's clearly zeroed in on this idea that the search ad business missed estimates, right? And the stock's down significantly after hours. It's basically what she didn't say. She said there was no specific geographic weakness. She talked about them seeing growth in YouTube as well as search, but wouldn't say kind of relative, I guess, to the street's estimates where the weak part was. What's so interesting here is, you guys can see the commentary. They're zeroed in on the cloud, and we did not send a hot headline on this, but if you look at the top line, cloud did beat expectations, but from an operating income perspective, cloud operating income basically came in double what the street was looking for. And what Porat had to say about that in particular is, there's a generative AI contribution here, but on a more macro perspective that I found interesting, she said that every single industry sector that buys cloud from Google is showing strength right now, which is kind of a change from the language we had toward the end of last year.
Absolutely, because cloud was the weak point of the last earnings report, and it seems like it's gotten back on track, whereas the ad sales was something that investors are really zeroing in on right now. Romain had made a good point earlier, which was that for these big tech companies, 2023 was really about cost cuts and getting their margins back to where they wanted to be. Did Ruth Porat say anything about cost cuts and expenses and what efficiencies look like in 2024?
Yes, that basically the plan is to reallocate talent within the company to higher growth areas, and that will, of course, include AI and AI's contributions to the cloud. If you think back to 12 months ago, Alphabet or Google did layoffs, frankly, in one fell swoop. But the strategy this time around has been to do it on a team-by-team basis. And what she explained to me on the phone is that the product managers look at the resources that they have, and they know what their targets are in those areas where things are growing highly. So the pace of hiring will reflect focus on the areas we know are growing more, we'll hire there, slow hiring in the areas where there is less growth, but also this reallocation. In other words, moving top engineering talent from one place to another, or focusing any spending on getting the best talent in AI, which, as you guys just heard from your last guest, they're not just dealing with their public market peers, the private market is out there in force offering big salaries for top engineering talent right now.
Yeah, it's a good reminder. Ed Ludlow, Bloomberg Technology co-host, thank you so much for bringing us those headlines from Ruth Porat, of course, CFO of Alphabet. Now, a number of other companies have reported results in the last couple of minutes. It's been a busy afternoon. So here now to take us through some of them are Bloomberg's Abigail Doolittle, Isabel Lee, and Emily Graffeo. Abigail, get us started.
Well, let's take a look at the shares of Mondelez because the Oreo, Cadbury, Philadelphia cream cheese maker, well, these shares are under pressure, down 3.6%, more than the implied move by options that was supposed to be up or down by 2.9%. Their fourth quarter relative to net sales, a small miss, relative to adjusted earnings, a small beat. But what's really grabbing the attention of investors, to the best of my ability to determine, is the fact that the organic net revenue growth, they're calling for 3 to 5% growth this year relative to the estimate of 6.6%. And one pressure last year for a lot of food makers, rising costs of cocoa, sugar, and butter, sweets in the spotlight there. But consumers had been paying up for it. So one question may be, is that demand still there? But I bet, Isabel, we're also going to have lots of questions about whether or not Ozempic, that flattened sales for them. And last quarter, I think that they said that wasn't the case. Let's see whether or not it's changing now. Isabel?
Thanks, Abby. So it's a miss across the board for Starbucks. We have the company's sales growing at their slowest pace in a year, and earnings are also missing estimates. So for Starbucks, it's the sluggish spending of consumers that are finally taking a toll on the company. Same-store sales rose 5%. That's lower than the 6.4% estimates. We have contributing to this is, of course, the weakness in China. And there's also the lower demand in some of the stores, especially in the Middle East. That's as some of the customers are saying that Starbucks is supporting Israel. This is a claim that Starbucks has repeatedly denied. So let's run you through some more numbers. We have earnings coming in at 90 cents a share. That's lower than estimates. And net revenue also at $9.4 billion. That's falling short of the $9.6 billion estimate. But we had the CEO saying that despite the headwinds, they are still a very strong brand and they continue to have a relentless pursuit with their partners. What about you, Emily? What do you got?
Well, Isabel, I'm looking at AMD, the second biggest maker of computer processors. That stock down about 3% in the post-market, but it was down even further after they first initially reported that their revenue forecast missed estimates for the first quarter. They're now seeing $5.1 billion to $5.7 billion in revenue. That missed estimates of $5.77. They did beat on fourth quarter revenue, and the fourth quarter adjusted EPS came in line. But really, overall, we're looking at a downbeat forecast, renewing investor concerns that demand for computer processors, for gaming consoles, is really slowing. And this is also echoing what we saw with Intel. What I really didn't get a chance to look at just yet, though, is AMD's push into artificial intelligence. So I think there's still some more questions about what we're going to learn in the next coming hours after this report about AMD and AI. Romain.
All right, nice wrap up there from Emily, Isabel, and Abigail. Chips, coffee, and Oreos. And now we turn our attention back to Microsoft and its CEO, Satya Nadella. When he first took over, the company was in a cat and mouse game with Apple over its devices. But when Bloomberg Opinion's Dave Lee spoke to Nadella back in 2015, he said he don't care what device people were using or what operating system, as long as they were accessing Microsoft products. Joining us for some anecdotes about Nadella's legacy is Dave Lee. Dave, great to have you here. And I was actually going through his legacy since he took over and just the growth of this company here. I mean, a company that had like a $300 billion market cap. I mean, just to show you how long ago this was, I mean, I think GE was still like the highest weighted name in the S&P 500. But explain that anecdote, because that really caught me by surprise. You wrote this in a column yesterday here about that anecdote and his sort of mission to be agnostic when it comes to the devices people use.
Well, the crucial thing is that Satya Nadella, he took over from Steve Ballmer, and Microsoft was kind of stuck. And one of the reasons why is that they were trying to protect its legacy business, i.e. Windows was the big thing. So that iPad, when I brought that to Satya Nadella, it looked as if I was kind of rubbing his face in the success that Apple had. But really, Satya Nadella, he didn't actually care, because he knew that the future of Microsoft was to sort of let go of its past and say, well, as long as we're in the cloud and as long as people are using Microsoft products anywhere, moving to this subscription model for software, then that was going to be a good way for Microsoft to grow. And that's precisely what they did. And that's come home to roost over the last 10 years since Nadella took over. But particularly in this last year, where we've seen that now Microsoft has the chance to apply AI to that vast user base. Yeah. And that is the reason why people are so excited about Microsoft. And in the time since that column published, it was Apple and Microsoft in this $3 trillion club. Now it's only Microsoft. And so, it's a real sense there that Satya Nadella's strategy has paid off hugely.
So under Satya Nadella, there's no sacred cow, whereas under Steve Ballmer, there certainly was, which was Windows, right? You have to protect it at all costs. Under Nadella, as you point out, the split, the breakdown between the different businesses are pretty even. Microsoft does not actually rely on one item or one business to get most of its juice, right?
Right, which is a real strength, because it means you can have a cloud platform that's not as big as AWS, but it's still be an important part of the business. Even things like the Xbox, not selling as well as Sony PlayStation, but that's going to be a big growth area as they move more of that into the cloud, and they recently, of course, acquired Activision Blizzard. What it allows them to do is just not have days like the day that Google's having, right? Where they have Google search advertising came in below expectations. All the investors freak out and go, well, that's the core business. Microsoft, obviously cloud's very important to Microsoft, but it's not the be all and end all. And so some of these different segments can fluctuate as they do, and Microsoft is still generally okay. And the best bit to bring AI onto this is that across all of those segments, you can add AI, and it's going to do something. It boosts the cloud, it boosts productivity, it will boost gaming. Just about everything that Microsoft does will get this layer of AI that should rise.
It's like a topper to every business line.
Absolutely.
Right? And it's all just profit. It's all just margin at that point. Dave, thank you so much. Dave Lee of Bloomberg Opinion, and of course you can check out Dave's columns on the Bloomberg terminal. So I love that description that Dave just gave, Romain, about how Satya Nadella is not worried about the hardware, is not worried about the products specifically.
Yeah.
All right, let's take a look at how markets closed on the day. We did have the S&P 500 little changed, but my guess is tomorrow, if things stay the way they are, it's going to be a decline given the big declines we're seeing in Alphabet right now and Microsoft at the moment as those companies get ready to report or hold their earnings conference calls. And you could see the 10-year yield moving up slightly, 2 basis points to 4.34%.
All right, when we come back, we're going to take a look back on this day and a major decision 12 years ago by the Fed and a major gaffe by Alan Greenspan. And we leave you with the question before we go to that commercial. What was the Fed's overnight lending rate on this day back in 2002? The answer when we come back. This is Bloomberg.
All right, we have some headlines here on Elon Musk. A judge has ordered that his $55 billion Tesla pay package has been voided. Again, Tesla's Elon Musk's $55 billion pay package has been voided by a judge. You can see the stock moving lower in after-hours trading by 1.5%. Tesla lower. And of course, the backdrop to this is that Musk had publicly appealed to the board of directors for another big stock award following his decision to sell about $40 billion in stock to pay taxes as he tried to fund his purchase of Twitter, which, of course, has since been renamed X. We'll continue to keep an eye on these developments for you. Romain?
All right, let's get back to it here and take a look back here at January 30th, 2002, marking the end of the most aggressive easing of monetary policy in Alan Greenspan's 14-year tenure as Fed chairman. Or did it? It started with an emergency rate cut back on January 2001, followed by 10 more cuts that took the overnight lending rate from above 6% to 1.75% in December 2001. But barely a month after the December meeting where policymakers indicated the 11 consecutive rate cuts were it, no more, no mas, Greenspan gave a speech in San Francisco where he suggested he's actually open to a 12th rate cut at that next January 30th meeting. He cited forces restraining the economic activity, comments that led to the biggest drop in U.S. Treasury yield since 9/11, a slide in the dollar, and a plunge in equities. But less than 2 weeks later, and 1 week before the next Fed meeting, Greenspan had to walk that back. He told the Senate Budget Committee he wanted to, quote, rectify investor interpretations about his speech, saying he created a, quote, phraseology, which in retrospect, I should have done differently. 2-year yield spiked 13 basis points, and a week later on January 30th, when the Fed met, the FOMC left interest rates unchanged at, yes, 1.75%. At the time, it was a 40-year low. It was a hard lesson about the power of Fed miscommunication for Greenspan, who often reveled in the ability to talk to markets in a way that said both a lot and, well, very little. A 2006 study by Lawrence Meyer and Brian Sachs measured the move in 2-year Treasury yields after speeches by Fed members before 2005 The effect of Greenspan's speeches averaged 1.4 basis points, and the cumulative effect of all of his speeches and testimonies was 5 times higher than for any other Fed official. We haven't seen the data yet on Jay Powell's ability to move the markets, but there's always tomorrow, Scarlett.
All right, let's stick with the Fed. That was great. And of course, as the FOMC prepares to make its latest rate announcement tomorrow at 2 p.m., we want to bring in John Bellows. He is portfolio manager at Western Asset Management. John, you heard what Romaine was saying. Have we come a long way, or perhaps not very far at all, when it comes to the Fed chief, Jay Powell in this instance, being really clear in telling markets what to anticipate?
You know, I did hear what Romaine said. I thought that was interesting. I'm not sure that December 2001 cut was the last cut of that cycle, though. I think they cut in 2003 because Greenspan was worried about underlying demand. So maybe that was the last cut of the cycle, but you can fact check me on that. Look, you know, I think what Powell says obviously matters tomorrow, and so we'll watch that. And he was quite dovish in December, and that had a big impact on markets, as you probably remember. But at the same time, I think the bigger story is what's going on with kind of the Fed mandates and where are we on those. And investors already know that. And it's pretty good. You know, inflation data is materially improved from 6 months ago and much, much better than it was 12 months ago. That's the big story. You know, obviously Powell's spin on that matters, but the improvement in the inflation data, that's the thing that matters. That we already know that. And, you know, that's really what's going to drive outcomes from here.
That's what's going to drive outcomes. And of course, the Fed has a dual mandate. The other part of it is to ensure maximum employment. And the hotter than expected job openings report today shows that the labor market remains very much intact and is showing strength. At what point does Powell start to shift his concern over to the labor market? Will the jobs report this Friday start to show cracks in that foundation?
You know, actually at Western Asset, we have a somewhat different view than that, which is I don't think the labor market's really a problem. I think the labor market is a real bright spot right now. You know, people are able to get jobs. You know, wages have been going up, but they've been going up mostly in line with prices. It's not causing inflation. Instead, it's just kind of reflective of a healthy labor market. We're seeing an increase in labor supply as workers are coming back into the labor market. So I think the labor market's a real bright spot right now. I think the concerns that it was too hot you know, over the last few years have been a little bit misguided. If the labor market were to weaken from here, then that would be a concern for Jay Powell. And, you know, clearly he's on guard for that. He has tools to deal with that. Rates are really high, and so he could cut if that happened. But I think for the moment, you know, Powell should feel pretty good about the labor market. I think it's a real bright spot. Like I said earlier, the problem had been inflation. That was driving things, and now that's looking better too. So I think Powell should be feeling pretty good right now on both dimensions. And I'm not real sure the labor market's something to worry about here.
Then what does he actually say? What does he tell the market, John? Because I think we're all looking at the same data. We all kind of know it, but we always know, too, that sometimes these Fed officials can put their foot in their mouths unintentionally here when they sort of try to communicate what the next step is going to be. There's got to be a next step, and they got to find a way to communicate it.
Yeah, well, and certainly Chair Powell has done that too. You know, he's not immune to it, so that's always a risk. In terms of what he says tomorrow, you know, I thought one of the messages in December was really quite impactful. Was when he said, "So far, so good," with regards to bringing inflation down. I still think that's applicable today. I wouldn't be surprised if he repeats that. You know, clearly, if the Fed chair is saying so far so good, that's indicative of a plan to lower rates at some point. We don't need these very elevated rates if so far so good is the you know, is kind of the description of what's going on. You know, I think he'll be a little bit coy about when exactly that rate cut's going to come. You know, that's always kind of tough to guess the exact meaning. But the big picture here is so far so good. We do not need these elevated rates. You know, and I think that's going to be a powerful message tomorrow.
All right, John Bellows, portfolio manager at Western Asset Management, helping us preview the FOMC decision at 2 p.m. tomorrow. Let's return to our breaking news, which we told you a moment ago, which is that a judge has voided Elon Musk's $55 billion Tesla pay package. We want to go now to Bloomberg Technology co-host Ed Ludlow in San Francisco. Ed, what else can you tell us?
Well, in the first instance, Tesla shares are down significantly in the aftermarket, more than 2%. What shareholders alleged in their suit is that Tesla's board and its directors did not act with impartiality when setting the $55 billion compensation, which is a historic record for any compensation package for a publicly traded CEO.
Yeah.
And the judge in this case, Kathleen St. Jude McCormick, is agreeing with that in the sense that investors had to go hunting to clarify whether or not there were conflicts of interest in the apportioning of that reward. And as you can see, the market paying attention when Musk took the stand to basically defend his position in that compensation. He said, well, I had nothing to do with it. I don't set my own pay. So how could there be any leverage that the board would put over me or me over the board, which is what the conflict of interest in question, the concern was about.
All right, Ed Ludlow there out in San Francisco. Let's go back to some actual breaking news here. Microsoft OpenAI in talks to lead a Figure AI funding round. Bloomberg's Mark Gurman speaking with people familiar with the matter, saying that Figure AI, which is basically this startup that's supposed to develop kind of these humanoid robots, in talk to raise as much as $500 million in a funding round that's led by both Microsoft and OpenAI in partnership here. This is a pretty big deal, not only just for the investment in Figure AI, but of course the cooperation between Microsoft and OpenAI in facilitating this deal.
Yeah, and also brings to mind what our guest was telling us earlier about how, the whole investing in the AI theme goes beyond the publicly traded companies, but in these private companies like this Figure AI. The other thing worth noting, too, is the FTC, of course, is looking into all the transactions Microsoft, Alphabet, along with Amazon have made when it comes to partnerships, any kind of investments in AI-type companies. This might fall under that category.
What's interesting, though, about that is I wonder how much power they have to really stop it, right? I mean, you can make an antitrust case when you're talking about majority stakes, or even if they took sort of a large minority stake, like, say like a 40% or something. I'm not exactly sure what percentage stake this would give them, but if this is something smaller than half, I'm not sure what leg the government has to stand on.
I believe Lena Khan is looking into how the companies have structured their transactions to avoid U.S. merger laws that would have required them to notify the antitrust regulators, and so they're going to dig into all the details.
Okay, well, there are about 1,000 unicorns that she needs to look at in the private market right now. They can't make it to the public market, and their survivability is kind of dependent on these types of deals.
Well, she's going to start with the ones that the big tech companies are investing in. How about that?
Yeah. All right. Well, Figure AI, of course, one of the big AI companies everybody's been keeping an eye on now. A new funding round led by Microsoft and OpenAI. $500 million is the top end of that range, according to reporting by Mark Gurman. All right, stick with us. We're going to set you up for what to watch tomorrow. This is Bloomberg. Well, we had a fire hose our earnings here on this Tuesday. Let's set you up for what to watch on Wednesday. We got a fire hose tomorrow, but it's going to be a little bit different. We start off with the big Treasury refunding announcement. That's supposed to come at 8:30 a.m. tomorrow.
Yeah, we know the Treasury has cut its estimate for borrowing this quarter to $760 billion from the previous $816 billion. How is it going to mix that up in terms of which kinds of Treasuries it sells and when?
Tech CEO is also going to be on Capitol Hill, a big hearing there involving child protection. And of course, the big event tomorrow is going to be that Fed meeting, Scarlett.
Yeah, Jay Powell takes the stage at 2:30 p.m., answers questions. People are going to be deciphering his various comments on higher for longer and where he sees inflation headed.
And you see these figures here. These are the forecasts coming out of that last meeting, of course, when they reach those summary of economic projections. Economic projections that I think a lot of people say may end up being a little bit unrealistic. But of course, a lot of disagreement as to whether the unrealistic nature is to the upside or the downside.
Absolutely. And of course, we're not even done with earnings yet. Today was really busy in terms of big tech earnings. But the big one I'm paying attention to, Romaine, is Boeing. Less about the financial numbers and more about what Dave Calhoun, the CEO, says about what changes they're making, how they're changing things.
Yeah, I thought the folks over at Bloomberg Intelligence put it really well, that at this point, this is less about speaking to the public and investors. Is really about speaking to regulators and legislators who, of course, are sharpening their knives. Thanks for joining us. We'll be back tomorrow with full coverage here of the Fed Decides and all the earnings coming after the bell. This is Bloomberg.